Presentation is for Accounting 221, Accounting Principles 1, Chapter 8, Receivables. The first three learning objectives for Chapter 8 are to define and explain common types of receivables and journalize sales on credit, to apply the direct write-off method for uncollectibles, and to apply the allowance method for uncollectibles, and estimate bad debts expense based on the percent of sales, percent of receivables, and aging-of-receivables methods. The last two learning objectives are to account for notes receivable, including computing interest and recording honored and dishonored notes, and to use the acid test ratio, accounts receivable turnover ratio, and days sales and receivables to evaluate business performance. The first learning objective is to define and explain common types of receivables and journalize sales on credit. A receivable occurs when a business sells goods or services to another party on account or on credit. It is a monetary claim against a business or an individual. The receivable is the seller's claim for the amount of the transaction. Receivables also occur when a business loans money to another party. A receivable is the right to receive cash in the future from a current transaction. It is something the business owns. It is an asset. Each receivable involves two parties, the creditor and the debtor. The creditor receives a receivable, an asset. The creditor will collect cash from the customer or borrower. The debtor is the party to a credit transaction who takes on an obligation payable, a liability. The debtor will pay cash later. The three major types of receivables are accounts receivable, notes receivable, and other receivables. Accounts receivable are sometimes referred to as trade receivables. An accounts receivable is the right to receive cash in the future from customers for goods sold or for services performed. Accounts receivable are treated as current assets and are usually collected within 30 to 60 days of the billing date. Notes receivable arise when a company loans money to its customers or another individual or business. Notes receivable usually have longer terms than accounts receivable. A note receivable is a written promise that a customer will pay a fixed amount of principal plus interest by a certain date in the future. The maturity date is the date when a note is due. Notes receivable are generally evidenced by a legally binding document called a promissory note, a written promise to pay a specified amount in the future. Usually the signer agrees to pay interest at a specified rate. Notes receivable are generally long-term assets, but some notes receivable may be short-term assets for 90 or even 180 days. Other receivables make up a miscellaneous category that includes any other types of receivable where there is a right to receive cash in the future. Common examples include dividends receivable, interest receivable, and taxes receivable. These other receivables may be either current or long-term assets, depending on whether they will be received within 1 year or less. Businesses that sell goods or services on account receive cash by mail, usually in the form of a check, or online payments via electronic funds transfer, EFT. So internal control over collections is important. As we discussed in the previous chapter, a critical element of internal control is the separation of cash handling and cash accounting duties. Most large companies also have a credit department to evaluate customers' credit applications to determine if they meet the company's credit approval standards. The extension of credit is a balancing act. The company does not want to lose sales to good customers, but it also wants to avoid receivables that will never be collected. For good internal control over cash collections from receivables, separation of duties must be maintained. The credit department should have no access to cash, and those who handle cash should not be in a position to grant credit to customers. If a credit department employee also handles cash, He or she could pocket money received from a customer. The employee could then label the customer's account as uncollectible, and the company would stop billing that customer. In this scenario, the employee may have uncovered his or her theft. As stated earlier, selling on account or on credit creates an accounts receivable. Businesses must maintain a separate accounts receivable account for each customer in order to account for payments received from the customer and amounts still owed. For example, Smart Touch Learning performs $5,000 in services for Brown on account and sells $10,000, the sales price of merchandise inventory, to Smith on account on August 8th. The revenue is recorded, and we've ignored cost of goods sold. These separate customer accounts receivable, for example, accounts receivable Brown, are called subsidiary accounts. The sum of all balances in subsidiary accounts receivable equals a control account balance. It is obviously impractical to include each individual accounts receivable on the balance sheet. A control account, accounts receivable, is maintained to represent the total of all the individual subsidiary accounts. When the business collects cash from both customers on August 29th, $4,000 from Brown and $8,000 from Smith, Smart Touch Learning records the payments in a journal entry and posts the entry to the T accounts. When the business collects cash from both customers on August 29th, $4,000 from Brown and $8,000 from Smith, Smart Touch Learning records the payments in a journal entry and posts the entry to the T accounts. By accepting credit cards and debit cards, businesses are able to attract more customers. Businesses also benefit from accepting payment by credit and debit cards. They do not have to check each customer's credit rating or worry about keeping accounts receivable records or even collecting from the customer, because the card issuer has the responsibility of collecting from the customer. Thus, instead of collecting cash from the customer, the seller will receive cash from the card issuer. While there is almost always a fee to the seller to cover the processing costs charged by the card issuer, most businesses consider the benefits of transferring the risk of not being able to collect from the customer and avoiding the cost associated with credit customers are greater than the cost of the processing fees. When a business factors its receivable, it sells its receivables to a finance company or bank, often called a factor. The business immediately receives cash less an applicable fee from the factor for the receivables. The factor, instead of the business, now collects the cash on the receivables. The business no longer has to deal with the collection of the receivable from the customer. The business receives cash associated with the receivable from the factor instead of the customer. Pledging of receivables is another option for businesses that need cash immediately. In a pledging situation, the business uses its receivables as security for a loan. The business borrows money from a bank and offers its receivables as collateral. The business is still responsible for collecting on the receivables, but it uses this money to pay off the loan along with interest. In pledging, if the loan is not paid, the bank can collect on the receivables. The second learning objective is to apply the direct write-off method for uncollectibles. Selling on account brings both a benefit and a cost. The benefit to a business is the potential increased revenues and profits by making sales to a wider range of customers. The cost, however, is that some customers do not pay, creating uncollectible receivables. Customers' accounts receivable that are uncollectible must be written off or removed from the books because the company does not expect to receive cash in the future. Instead, the company must record an expense associated with the cost of the uncollectible account. Bad debts expense is the cost to the customer of extending credit. It arises from the failure to collect from some credit customers. There are two methods of accounting for uncollectible receivables and recording the related bad debts expense: direct write-off method and allowance method. The direct write-off method of accounting for uncollectible receivables is primarily used by small non-public companies. Under the direct write-off method, accounts receivable are written off and bad debts expense is recorded, when the business determines that it will never collect from a specific customer. Once an accounts receivable is written off, the company stops pursuing the collection. Some companies might turn over delinquent receivables to an attorney or a collection agency to recover some of the cash for the company, but generally companies do not expect to receive any future payment. Dan King's subsidiary accounts receivable account will be credited for $200 to remove the uncollectible account from the books. In addition, a corresponding $200 debit will be posted to the bad debts expense account. Even though customer accounts are sometimes written off, the customer may still feel an obligation to pay the amount owed. If at some future date the customer is able to send in the original payment, the company reverses the earlier write-off. Then the company records the payment by debiting cash and crediting the customer's accounts receivable account. The direct write-off method violates the matching principle. The direct write-off method is only acceptable for companies that have very few uncollectible receivables. The third objective is to apply the allowance method for uncollectibles and estimate bad debts expense based on the percent of sales, percent of receivables, and aging of receivables methods. The allowance method is based on the matching principle. Thus, the key concept is to record bad debts expense in the same period as the sales revenue. The allowance method is a method of accounting for uncollectible receivables in which the company estimates bad debts expense instead of waiting to see which customers the company will not collect from. To do this, we will rely on past experience and our understanding of the axiom that the older accounts receivable are, the less likely it is that we will actually collect them. The offset to the expense is a contra asset account called allowance for bad debts or allowance for doubtful accounts. The allowance for bad debts is a contra account related to accounts receivable that holds the estimated amount of uncollectible accounts. The allowance reduces the asset accounts receivable. The net realizable value is the net value a company expects to collect from its accounts receivable. Net receivable value is accounts receivable less allowance for bad debts. The entry to establish the allowance for bad debt associated with the accounts receivable balance will include a debit to bad debts expense for $80 and a credit to allowance for bad debts for $80. Accounts receivable will be reported on the balance sheet, but it will now be shown at the net realizable value. The balance sheet now reports the amount of accounts receivable that Smart Touch Learning expects to collect, $4,320. The contra account allowance for bad debts is subtracted from accounts receivable, showing that although $4,400 is owed to Smart Touch Learning, the company estimates that $80 of accounts receivable will be uncollectible. When using the allowance method, companies still write off accounts receivable that are uncollectible. However, instead of recording a debit to bad debts expense, as is done when using the direct write-off method, the company will record a debit to allowance for bad debts. Bad debts expense is not debited when a company writes off an accounts receivable when using the allowance method, because the company has already recorded the bad debts expense as an adjusting entry. On January 10, 2020, Smart Touch Learning determines that it will not collect $25 from customer Sean Clark. The allowance for bad debt account is debited for $25, and the account receivable Clark account is credited for $25. The entry to write off a receivable reduces the amount of the allowance for bad debts account and also the accounts receivable account, but it does not affect the net realizable value shown on the balance sheet. This is because both allowance for bad debts contra asset and accounts receivable asset were reduced by the amount of the write-off. In addition, the write-off of a receivable does not affect net income because the entry does not involve revenue or expenses. Occasionally, a customer will decide to pay us even after the account has been written off. This requires two entries. The first entry will reverse the earlier write-off. The second entry will receive the cash again against the reinstated accounts receivable. How do companies determine the amount of bad debts expense when using the allowance method? Companies use their past experience as well as consider the economy, the industry they operate in, and other variables. In short, they make an educated guess called an estimate. There are three basic ways to estimate uncollectibles: percent of sales, percent of receivables, and aging of receivables. The percent of sales method is a method of estimating uncollectible receivables that calculates bad debt expense based upon a percentage of net credit sales. The percentage will be based on experience and an actuarial assessment of historical patterns. This method is called the income statement approach because it focuses on the amount of expense that is reported on the income statement. The percent of sales method is a method of estimating uncollectible receivables that calculates bad debt expense based upon a percentage of net credit sales. The percentage will be based on experience and an actuarial assessment of historical patterns. This method is also called the income statement approach because it focuses on the amount of expense that is reported on the income statement. At December 31, Smart Touch Learning debits bad debt expense and credits allowance for bad debts for $300. After posting the adjusting entry, Smart Touch Learning has the following balances in its accounts. Accounts receivable, $6,375 debit balance. Allowance for bad debts, $355 credit balance. And bad debts expense, a $300 debit balance. The percent of receivables method of estimating uncollectible receivables involves determining the balance of the allowance for bad debts account based on a percentage of accounts receivable. This approach is called the balance sheet approach because it focuses on accounts receivable, a balance sheet account, and determines a target allowance balance based on a percentage of the receivable balance. The calculation for bad debts expense under the percent of receivables method is a two-step process. First, the company determines the target balance of allowance for bad debts. Then it uses the target balance to determine the amount of bad debts expense. In step 1, the company determines the target balance for the allowance for bad debts account, $255, $6,375 times 4%. Next, its accountant determines the amount of bad debts expense adjustment. $255 minus $55 is equal to $200. On December 31st, Smart Touch Learning records a debit to bad debts expense and a credit to allowance for bad debts for $200 to recognize bad debts expense for the year. After posting the adjusting entry, Smart Touch Learning has the following balances in its accounts. Accounts receivable, $6,375 debit balance. Allowance for bad debts, $255 credit balance. And bad debts expense, $200 debit balance. If a company has a debit balance before the adjustment, the calculation for bad debts expense is a little different. Instead of subtracting the unadjusted balance of the allowance for bad debts from the target balance, the unadjusted balance will be added to the target balance. Notice in the above example that when the allowance account has an unadjusted debit balance, the target balance must be added to the unadjusted balance of the allowance for bad debts to determine the bad debts expense adjustment. The aging of receivables method is a method of estimating uncollectible receivables by determining the balance of the allowance for bad debts account based on the age of individual accounts receivable. We first break the accounts receivable into age groups. Each age grouping will have a different expectation of uncollectability. Once we know the target balance for allowance for bad debts and we know the existing balance of allowance for bad debts, we can determine the bad debts expense as the difference between the two previous totals. Exhibit 8.1 shows the aging of the accounts receivable for Smart Touch Learning. Total accounts receivable is $6,375. However, the balance can be broken down into 4 balances. Those balances represent various transactions of differing ages. We can tell from the exhibit that our target balance for allowance for bad debts is $185. The procedure for recording the year-end adjusting entry under the aging of receivables method is similar to the percent of receivables method. Based on Exhibit 8.1, Smart Touch Learning knows the target balance of the allowance for bad debts account is $185. Smart Touch Learning will determine its bad debt expense by subtracting the $55 unadjusted credit balance in the allowance account from the target balance, which is $185. After posting the adjusting entry, Smart Touch Learning has the following balances in its accounts. Accounts receivable, a $6,375 debit balance, allowance for bad debts, $185 credit balance, and bad debts expense, $130 debit balance. Exhibit 8.2 shows the journal entries that are recorded when using both the direct write-off method and the allowance method of accounting for uncollectibles. Review the differences between these two methods. Remember that when using the direct write-off method, the business does not use an allowance account and that this method does not conform with GAAP. Under the allowance method of accounting for uncollectibles, businesses must estimate the amount of the bad debts expense at the end of the accounting period. This is done using one of three methods: percent of sales, percent of receivables, or aging of receivables. Exhibit 8.3 summarizes the differences among these three methods. The fourth learning objective is to account for notes receivable, including computing interest and recording honored and dishonored notes. Promissory note, a written promise to pay a specified amount of money at a particular future date, usually with interest. Maker of the note, debtor, the entity that signs the note and promises to pay the required amount. The maker of the note is the debtor. Payee of the note is the creditor, the entity to whom the maker promises future payment, and the payee of the note is the creditor. The creditor is the company that loans the money. Principal, the amount loaned by the payee and borrowed by the maker of the note. Interest, the revenue to the payee for loaning money. Interest is an expense to the debtor and revenue to the creditor. Interest period, the period of time during which interest is computed. It extends from the original date of the note to the maturity date and is also called the note term. Interest rate, the percentage rate of interest specified by the note. Interest rates are almost always stated for a period of 1 year. Maturity date, as stated earlier, this is the date when final payment of the note is due, also called the due date. Maturity value, the sum of the principal plus interest due at maturity. Maturity value is the total amount that will be paid back. In order for a note receivable to be enforceable, it must be evidenced by a signed promissory note. The note must have 4 primary components. The principal amount must be stated on the face of the promissory note. The interest period must be identified. The interest rate must be identified. The promissory note must be signed by the maker. On September 30th, Smart Touch Learning loaned $1,000 to Lauren Holland for 1 year at 6% annual interest. Smart Touch Learning records a debit to notes receivable and a credit to cash for $1,000. Note, interest is recorded only after time has passed. At the time of the issuance of the note, no time has passed. Hence, there is no interest yet to be recorded. Remember that all interest rates are always stated as annual rates. Some notes specify the maturity date. Other notes state the period of the note in days or months. When the period is given in months, the note's maturity date falls on the same day of the month as the date the note was issued. When the period is given in days, the maturity date is determined by counting the actual days from the date of issue. A 180-day note dated February 16, 2019 matures on August 15, 2019. At the end of the accounting period, if the note is not yet due, interest will need to be accrued. The approach is fairly straightforward. Amount of interest is equal to principal plus interest rate times fraction of a year that the note has been outstanding. Using the data in Exhibit 8.4, Smart Touch Learning computes interest revenue for 1 year as follows: $1,000 times 6% times 12 divided by 12. The maturity value of the note is $1,060, $1,000 principal plus $60 interest. The time element is 12 divided by 12, or 1, because the note's term is 1 year. When the term of a note is stated in months, we compute the interest based on the 12-month year. When the interest period is stated in days, we sometimes compute interest based on a 360-day year rather than on a 365-day year. A 360-day year eliminates some rounding and was used frequently in the past. However, with the use of computers to calculate interest, a 365-day year is more common now. The entry will require a debit to interest receivable for $15 and a credit to interest revenue for $15. How much interest revenue does Smart Touch Learning earn in 2018 for January 1 through September 30th? Smart Touch Learning earns 9 months of interest, which is 1,000 times 6% times 9 divided by 12 equal to $45. On the maturity date of the note, Smart Touch Learning will receive cash for the principal amount plus interest. The company considers the note honored and records the journal entry. How much interest revenue does Smart Touch Learning earn in 2020, January 1 through September 30th? Smart Touch Learning earns 9 months of interest, which is $45. On the maturity date of the note, Smart Touch Learning will receive cash for the principal amount plus interest. The company considers the note honored and records the journal entry. On July 1, 2019, Rosa Electric sells household appliances for $2,000 to Dorman Builders. Dorman signs a 9-month promissory note at 10% annual interest. Sports Club cannot pay Blanding Services the amount due on accounts receivable of $5,000. Blanding accepts a 60-day $5,000 note receivable with 12% interest on November 19, 2019. On December 31, the note has been outstanding for 42 days. On that day, $69, which is $5,000 times 12% times 42 divided by 365 days, of interest revenue is accrued with a debit to interest receivable and a credit to interest revenue. 18 days later, on January 18th, the remaining $30 of interest revenue, which is calculated as $5,000 times 12% times 18 divided by 365 days, is accrued with a credit. $5,099 cash is received or debited, and the receivables are removed with credits. If the maker of a note does not pay at maturity, the maker dishonors a note, also called defaulting on a note. Because the note has expired, it is no longer in force. Dishonoring a note is a failure of a note's maker to pay a note receivable at maturity. When a note receivable is deemed uncollectible or goes into default, it is often first transferred to an account receivable, along with any unpaid interest. We then apply our accounts receivable policies to determine when this new account receivable will be written off. Even though the note has expired, the debtor still owes the payee. The payee can transfer the note receivable amount to accounts receivable. Suppose Rubenstein Jewelers has a 6-month 10% note receivable for $1,200 from Mark Adair that was signed on March 3, 2019, and Adair defaults. Rubenstein Jewelers will record the default on September 3, 2019. Rubenstein will then bill Adair for the account receivable. This also allows Rubenstein to eventually write off the receivable using either the direct write-off method or the allowance method if at a later date Rubenstein still cannot collect the account receivable. The fourth learning objective is to use the acid test ratio, accounts receivable turnover ratio, and days sales in receivables to evaluate business performance. The balance sheet can be used to calculate various ratios such as the acid test ratio, accounts receivable turnover ratio, and days sales in receivables. Exhibit 8.8 shows Kohl's Corporation's partial balance sheet. This company has relatively few assets. Therefore, we will use a different company to illustrate the calculation of the ratios in this chapter. This slide shows a summary of financial information for Sears Holdings Corporation. We will use this information to calculate the ratios in the following slides. The acid test ratio is the ratio of the sum of cash, cash equivalents, short-term investments, and net current receivables to total current liabilities. This ratio tells whether the entity could pay all its current liabilities if they came due immediately. The result is a ratio that gives us an idea of whether the company currently has sufficient liquid assets to cover current liabilities. Sears Holdings Corporation's acid test ratio, January 30th, 2016, equals 0.12. This indicates that it has 12 cents of quick assets to pay each $1 of current liabilities. The accounts receivable turnover ratio is computed by dividing net credit sales for the period by the average net accounts receivable for the period. Typically, average net accounts receivable is computed as beginning net accounts receivable balance plus ending accounts receivable balance divided by 2. If this number goes up, it is an indication that sales are slowing down. Sears Holdings Corporation's accounts receivable turnover ratio at January 30th, 2016 is 59.31. This indicates that it turns over its receivables 59.31 times a year. The days sales in receivable is the ratio of average net accounts receivable to 1 day's sales. The ratio tells how many days it takes to collect the average level of accounts receivable. The length of the collection period depends on the credit terms of the sale. For example, sales on net 30 terms should be collected within approximately 30 days. When there is a discount, such as 210 net 30, the collection period may be shorter than 30 days. Credit terms of net 45 result in a longer collection period than 30 days. Sears Holdings Corporation's days sales in receivables is 6 days. This indicates that on average it takes Sears Holdings Corporation 6 days to collect its accounts receivable. This is the conclusion of the presentation on Chapter 8.